Welcome to this explainer. Today, we're diving into automatic data processing, or as you probably know them, just ADP. Now, this is a $112 billion human capital management behemoth. It's truly a cornerstone of the American economy. But looking at their August 2026 market analysis, we're presented with a really fascinating puzzle. See, ADP is out there posting stellar, record-breaking numbers, but Wall Street is completely torn on its future. Analysts are just fiercely divided on exactly where this stock is headed next. So let's unpack this and find out why.
First things first, to really grasp the core of ADP's business, you've got to understand the sheer magnitude of this number right here, 1 in 6. Just think about that for a second. 1 out of every 6 private sector employees in the United States gets their paycheck processed by this single company. It's massive. That scale means they aren't just selling business software, they're essentially a real-time pulse on the entire broader economy. That deep integration into the American workforce is the foundation of literally everything we're about to discuss today.
Okay, here's our roadmap. We'll start with their record-breaking fiscal 2026, then look at their AI-defining moment, dive into Wall Street's great debate, check out the FY27 outlook and headwinds, spend some time weighing the key risks, and finally wrap up with the final verdict.
Let's jump right into Section 1, Record-Breaking Fiscal 2026. This goes way beyond basic payroll.
So, fiscal 2026, it was remarkably strong across the board for them. Top-line revenue hit an impressive $21.95 billion, which is a solid 7% growth year over year. Net earnings steadily climbed 8% to $4.4 billion. But the real standout here, the number that really turns heads, is that 11% leap in adjusted earnings per share, hitting $11.12 and handily beating analyst estimates. What really stands out to me is how this shows off their incredible operating leverage. I mean, they're taking a 7% revenue bump and turning it into an 11% profit jump per share. And the momentum right at the finish line was just huge, delivering a massive 17% adjusted EPS growth in the fourth quarter alone.
But ADP's financial victories go way beyond just top-line revenue. In the software and services world, boasting a 92.1% client retention rate in employer services is frankly an incredible defensive moat. It basically means once clients are hooked into their ecosystem, they almost never leave. And that's backed up by record-high client satisfaction for the 3rd consecutive year. Plus, because they have this huge, captive, happy audience, they can cross-sell like crazy. Take the retirement services division, for example. It just crossed a massive milestone, surpassing $1 billion in annual revenue for the very first time. So they aren't just processing biweekly paychecks anymore. They're building out a completely comprehensive financial ecosystem for employers.
And then there's this number, 51. 51 years. That is over half a century of steadily returning capital back to shareholders. Hitting your 51st consecutive year of dividend payments is a seriously rare and prestigious milestone. When you stop and think about all the macroeconomic chaos of the last 5 decades, 1970s inflation, the dot-com bust, the 2008 financial crisis, all the recent global disruptions, through all of that, ADP has consistently generated enough cash to reward its investors. This number absolutely cements their reputation for legacy stability no matter what the broader economy throws at them.
Moving on to Section 2, the AI-defining moment, reinventing human capital management.
Now we're shifting gears from historical stability to futuristic innovation. CEO Maria Black recently made a pretty bold declaration, calling artificial intelligence, quote, a defining moment for the human capital management industry. Management clearly doesn't see AI as just a passing tech trend or some minor feature update to throw on a press release. They view it as a ground-up, fundamental shift in how complex HR, payroll, and compliance systems operate, moving everything from reactive record-keeping to proactive, intelligent management.
And look, we all know the market is absolutely flooded right now with companies just sprinkling the word AI into their earnings calls to generate hype. But ADP actually has the hard data to back it up. 12 million. That's the staggering number of actual, real-world conversations clients had with ADP Assist Agents during fiscal 2026. This isn't some closed beta test. This is massive, tangible adoption across their base of over 1.1 million clients. They've effectively deployed AI at an enterprise scale, and their clients are actively relying on it every day to solve real operational problems.
So, what does this ecosystem actually look like in practice? Well, ADP Assist wasn't just acting as a basic chatbot. It surfaced 45,000 vital compliance insights for clients, essentially catching potential regulatory issues before they turned into hefty fines. Then, internally, they have an AI-powered productivity tool called The Zone, which is now used by nearly half of ADP's own service associates to speed up their workflows. And for the massive global organizations, their next-gen platform, Lyric HCM, saw a phenomenal 94% increase in live enterprise clients. Here's the most critical takeaway on this. Payroll must be 100% accurate across thousands of different tax jurisdictions. Because of that, AI in this space doesn't just blindly eliminate jobs, it's actually managing all that immense added complexity and compliance friction, fundamentally reshaping the industry at the granular daily task level.
Which brings us to Section 3, Wall Street's Great Debate, Navigating the Consensus.
All right, so despite those incredible fiscal 26 results and a highly successful AI rollout, the analyst community is completely divided on ADP stock. It's wild. You've got Cantor Fitzgerald sitting confidently at a bullish buy rating with a $310 price target, but step across the aisle and Stifel Nicolaus calls it a hold at $285. UBS is sitting at neutral around $280, and JP Morgan actually slaps a sell rating on the stock with that same $280 target. When you pull it all together and average out the 18 major analysts polled, it all washes out to a very cautious consensus hold. So what exactly is driving this sharp ideological divide on such a historically dominant company?
It really boils down to a classic market debate. The bull case points to that 300-plus price target, arguing that ADP's aggressive AI-driven growth and its defensive, super high-quality business traits absolutely justify its current premium valuation. The company is trading at roughly a 25 times price-to-earnings ratio, which is notably higher than the industry average of 22. Bulls say, hey, you pay up for quality, but the bear case pegs fair value significantly lower, down around the $220 to $240 mark. The bears are worried that newer, agile, SaaS-native rivals might force ADP to lower prices just to compete. They point to that exact same 25x PE premium, not as a badge of quality, but as a major risk factor if growth starts to slow down.
And that leads us to Section 4, FY27 Outlook and Headwinds. Are we seeing a step down in growth? When we look at the projections for the upcoming year, the tide is definitely shifting a bit. After delivering that robust 7% revenue growth in fiscal 2026, the forward-looking guidance for fiscal 2027 shows a clear deceleration, dropping down to the 5 to 6% range. Adjusted EPS growth is also projected to moderate, landing somewhere between 9 and 11%. Along with some slight expected headwinds from foreign exchange rates. Now, don't get me wrong, 5 to 6% growth is still very healthy for a legacy giant, but for investors who are being asked to pay a premium earnings multiple, any step down in the growth rate is naturally going to be a serious point of friction.
To truly contextualize why growth is slowing, we have to look outside the four walls of the company and at the broader macroeconomic environment. CEO Maria Black perfectly captured the current labor market, describing it as, quote, generally stable but muted, a low-hire, low-fire environment. And here is why this matters so deeply for ADP. They make a significant chunk of their money on payroll processing volumes, a metric they call pays per control. When companies aren't hiring new staff, when we're in a low-hire environment, ADP's transaction volumes stall out. They miss out on those highly profitable incremental processing fees. It's a direct mirror of the broader economy impacting their top line.
But management is putting their money exactly where their mouth is to counter these headwinds. Despite this muted economic environment, they are showing immense confidence in their future cash flow. The board of directors just authorized a massive $6 billion share repurchase program. On top of that, they successfully issued $1 billion in 5% senior notes due all the way out in 2036. By locking in long-term capital and aggressively buying back their own stock, leadership is heavily backing their own business model. They're signaling loud and clear to the market that they believe their shares remain undervalued.
Let's look at Section 5, Weighing the Key Risks, the Bear Horizon.
If you're weighing the bear case for this stock, it really comes down to a few core fronts. First up is the valuation trap. Sitting at a 25 times PE ratio, any earnings miss could trigger severe multiple compression. That risk is definitely amplified by the decelerating revenue growth we just talked about for fiscal 2027. Then you've got the competitive and macro threats. Agile SaaS-native AI startups trying to chip away at market share, combined with a high sensitivity to a flat labor market with low transaction volumes. And finally, there's the rate exposure. Payroll processors hold massive amounts of client funds before payday, and they earn interest on that float. If the Federal Reserve starts cutting interest rates, that highly profitable revenue stream shrinks. All of this helps explain why, despite a massive 49% recovery from its 52-week lows, the stock was still technically down year-to-date at the start of fiscal 2026.
Finally, Section 6, the final verdict, synthesizing the pieces.
So we have covered a lot of ground today. We've unpacked the historical strength of an absolute juggernaut that processes 1 in 6 American paychecks. We've seen their incredibly successful, data-proven pivot into artificial intelligence, and we've examined the very real macro and valuation headwinds they're currently navigating. Which leaves us with one final, absolutely crucial question. Is ADP's premium quality already fully priced into the stock? You really have to weigh that massive, undeniable defensive moat and a 51-year dividend legacy against a premium price tag in a slowing, low-hire labor market. We'll leave you to think about how those pieces fit together for you before making your own investment decisions. Thanks for joining us for this explainer, and keep learning.